Brad Williams, Frugal Finance, bond rating coverage. The bond rating given by a rating agency are generally based upon publicly available information, although private information expressed by the company to the rating agency does not play an important role. The rating that is delegated to a company's bond will depend in large part on financial ratios that determine the ability of the company to make its debt payments and turn out steadily in knowable cash flows. Bottom line, cash flows, present value, future value. You understand those three ingredients, you're 99% of the way through finance. Those are the three key factors that pretty much drive finance. While a ton of financial ratios exist, Worksheet 1.2 sums up a few of the key ratios that are used to measure default risk. We're going to have a pre-tax interest coverage, EBITDA interest coverage, earning before interest, taxes, and appreciation. Funds from operations divided by total debt. That looks like a cash flow deal. Free operating cash flow divided by total debt. Pre-return on capital. Operating income divided by sales. Long-term debt divided by capital. Total market capital or book capital. I think we look at book value here and then total debt over all debt. So what are we looking at here? Pre-tax income from continuing operations plus interest expense divided by gross interest. You just open up your financial statement and you just start crunching numbers. EBITDA divided by gross interest. You're going to get a ratio. Net income from continuing operations plus depreciation divided by total debt. Funds from operation minus CapEx minus change in working capital. It looks like a reinvestment. Pre-tax income from continuing operations plus interest expense, average of beginning. So you're just out of college, you've studied finance, and you're working for one of the banks. Well, guess what? This is what you're going to do. It's just numbing. Because after 3 weeks, you're going, oh my God, this is just boring as hell. Yep, it's boring as hell, but it's part of the job. You have to go through the stages, and this is the stage of evaluating financial ratios, and in this case, fixed income. Here's just a schedule. The ratios used by the rating agencies. For AAA, your EBIT coverage was 17.5, and then as things start to decline, for whatever reason, there's too many variables to identify, but you can see you have an EBIT coverage, so it'd be interesting to evaluate this. I'm not a fixed income person, I'm an equity person. So I was just looking at the difference between here and here in terms of percentage. It's a magnitude of effect. I mean, it's huge. Note that the pre-tax interest coverage ratio and EBITDA interest coverage ratio are presented in terms of time interest earned. The other ratios are presented in percentage terms. Not unexpected, companies that produce income and cash flows that are drastically greater than debt payments are profitable. With low debt ratios are expected to be highly rated than are companies that do not have these strengths. There will be individual companies whose ratings are not uniform with their financial ratios, yet since the rating agencies do bring skewed conclusions into the final mix. So a company that performs badly on financial ratios but is likely to further perform it spectacularly over the next period could get a higher rating than that reasoned by its current financial. Bond ratings and interest rates. The interest rate on a corporate bond should be a measure of its default risk. If the rating is a good assessment of the default risk, higher rated bonds should be priced to yield lower interest rates than would lower rated bonds. The difference between the interest rate on a bond with default risk and a default-free government bond is called the default spread. This default spread will differ by maturity of the bond and may vary from time to time depending on economic factors. Worksheet 1.4 summarizes default spreads in early 2020 and early 2021 for 10-year bonds in each rating class using S&P ratings and the market interest rates on these bonds, based upon a treasury bond rate of 1.29%. The interest rate on bond, so you have a default spread 0.62. What's the difference here? 1.9 minus 1.29 should equal 0.62. interest rate on bond. As we go down, interest rate on bond, you can see skyrockets up to, look at the spread there, 14.83%. Here's the spread. Here's the treasury bond, and you're going to add this, 1.29 plus this. We're going to copy that down, control down. We're going to shrink this. There you go. There is the default spread, 13.55. That's the risk factor an investor would demand in order to buy a D-rated bond. That means a default bond. And today, with this up to nearly 5%, you can see that it's really expensive to be buying junk bond. Worksheet 1.4 shows default spreads at a point in time, but default spreads not only fluctuate over time, but they can change for bonds with an identical rating but different maturities. For the bonds with higher ratings, the default spread usually widens for the longer maturities. For bonds with lower ratings, the spreads can decrease as we go to longer maturities, suggesting the truth that near-term default risk is greater than long-term default risk. Historically, default spreads for all rating categories have increased during recessions and decreased during economic booms. Note how much default spreads changed through 2021. This suggests that default spreads for bonds must be reestimated at regular intervals, particularly if the economy shifts from low to high growth or vice versa. A final note is that everything that has been mentioned about the relationship between interest rates and bond ratings could be stated generally about interest rates and default risk. The availability of bond ratings is a convenience that makes the evaluation of default risk fairly easier for us when examining companies. It is, in its absence, we would still have to evaluate default risk on our own and come up with estimates of the default risk, the default spread we would charge if we were lending to companies. The bottom line here is, how much do you trust the rating agencies? How accurate is their information? If there's some truth to their data, then go ahead and use their information. Sometimes you're going to have to do your own bond rating. Again, it's a matter of time. If you have the time, do your own bond rating. And if you look at that information on the general contractor page, you can do it on your own. There's enough hints there that you should be able to plug and chug and come up with your own rating. Industry-specific risk, these are unexpected outcomes of project cash flow, industry-wide changes in technology, amendments in laws, or in the price of commodities. Market risk is the unanticipated adjustment in project cash flow produced by changes in interest rates, inflation rates, and just a whole slew of other factors. Competitive risk, this is the unanticipated effect on the cash flows in a project or competition. International risk, riskless assets. Risk is in the eye of the beholder. A privately owned company will usually end up with a higher discount rate just because they're private. Why? The lack of diversification. I'll explain more. Diversification, this is the practice of owning many investments in a portfolio, either amongst the same asset class stocks or many asset classes. Why? You remember that covariance thing I was talking about? Security analysis. Project-specific risk, this is the key here. In this session, or in this collective group of courses, we're going to be focusing on project-specific risks. This is the risk that influences just the project under consideration and might come from things exclusive to the project or estimation error. Now in beta, the beta of any investment is the CAPM, is a standard measure. There's a lot of different means to measure risk. Beta is the predominant, but there are endless if you want to incorporate that into your analysis. Brad Williams, Frugal Finance. Thanks for watching.